Hi there, Stephen Thomas with Reports on Housing. I'm coming to you on Friday, May 9th, 2025 to bring you the latest housing debrief. This week we're focusing on housing crash or housing cracks. And what is going on is we're actually seeing a real slowdown in the housing market. It began last year in 2024, and then it's continued to slow throughout 2025, bringing us to where we are at, the start of May. And for many, they're wondering, gosh, is this a housing crash, or is this just cracks in the strong foundation of the housing market? So I'm going to go back in time, and we're going to kind of go over the evolution of housing, which brings us to where we are actually right now today. And there was the great financial crisis, the Great Recession that occurred, and values plummeted, and there was a lot of banks that went under. It was a disastrous time, the Great Recession. It was the worst recession since the Great Depression. And out of that, there was a housing recovery and also expansion that lasted from 2012 through 2019. And what happened was the Federal Reserve actually stepped in. And by the time we got to the end of 2008, they brought the federal funds rate down to 0%. And the federal funds rate is an overnight banking rate. And so they brought that down to 0%. They did other things as well. We're not going to get into quantitative easing and quantitative tightening and all that good stuff. But they pulled as many levers as they possibly could and brought the overnight banking rate down to 0%. And that lasted all the way from 2008 through 2016, and they started to ratchet up the federal funds rate after that. That was part of the going from recovery towards expansion. And you could see what happened as a result of that. Interest rates, they were anywhere from about the mid threes up to about 5%. As a matter of fact, it hit 5% in the November of 2018, and everybody was freaking out with those 5% interest rates. But interest rates were really favorable for a very long time, and as a result, the housing market was appreciating at a pretty good clip year after year after year. And then along came the coronavirus, 2020 through 2021. And that really rocketed the world, and the Fed once again stepped in. And this time they pulled as many levers as they possibly could. Also, things that they learned from the Great Recession, they then pulled as many levers, like I said, that they could. And as a result, one of the levers was they brought that federal funds short-term rate down to 0 again. They also did that quantitative easing that I talked about as well. So they brought it down to 0. And as a result, we saw rates during COVID. At first, they went really high. You could see that on the left-hand side of this chart. These are mortgage rates over time. And you could see that mortgage rates hit well over 4%, and they made their way down, all the way down into the lowest rate was 2.65 in January of 2021. And as a matter of fact, from the start of COVID all the way to January of 2021, there were 17 all-time record lows in the 30-year mortgage rate. So we hit one low after another low after another low. And as a result, housing absolutely took off. Housing took off, and because housing took off, and it just ate into an inventory that was already really low and became even lower because of demand. There was so much pending sales activity that in 2021 was an exceptional year that rivaled prior to the Great Recession as well. We saw values skyrocket during this time period. And that brought us to the next phase of housing and the economy. That was 2022 to present, and that was the inflation that resulted from the pandemic. And as a result, every pandemic causes mass amount of inflation. Afterwards, it's an initial, one of those shocks that occurs after you have supply chain issues, and it goes with that global pandemic. And as a result, we saw inflation really go up high. It's not as high as where we were during the 1970s and 80s, which a lot of people like to compare this recent bout of inflation to, but that's actually not correct. You could see what I'm pointing to. This is the highest that inflation got to was a little bit over 6%. And you could see that back in the day, it had eclipsed 14%. But still, nonetheless, we hadn't seen inflation for a very long time. And this was the highest level of inflation that went all the way back to the 1980s. So inflation was rampant. And as a result, the Fed once again stepped in. And this time, for 11 different times, they actually ratcheted up the short-term rate and brought it to a level that we had not seen since prior to the Great Recession. So it was such a rapid increase as well. We watched interest rates absolutely explode from 3.25% all the way up to above 7% in 2022. And they started ratcheting this up in 2022 and kept on going all the way until July of 2023 was the 11th time that they raised the short-term rate. And you can see since then, starting last September, they started to come down in the federal funds rate. But nonetheless, when they went up 11 times, that was very restrictive lending, and it was way more restrictive than what they had before. So as a result, it really automatically, what we saw with housing is it slowed down tremendously. There was a waterfall dive in the number of home sales. And you could actually see this is 2022, that started off really strong, but as the year progressed and interest rates rose higher and higher from 3.25% all the way to 7%, you saw that the annual rate of existing home sales was dropping on a monthly basis. And since then has remained very, very low. And you could see that from the second half of 2022 all the way through where we are right now in 2025. The existing home sales has remained extremely low compared to the potential demand that's out there if we had rates that were even at 6% versus where we've hung out very, very close to 7% for quite some time. And even though we have those low rates, this is very, very telling. And this is the Freddie Mac House Price Index. And I like house price indices over median sales price because it really does tell you kind of where things are going. And we're actually, for the United States, up 3% year over year. And this is through March of 2025. And it's up 8% from the 2022 peak. The 2022 peak is right in the middle before you see those bars that are going down consecutively. And that was for the second half of 2022. But it's actually since June of 2022 to present, it's gone up 8% in value. And so even though we have these high prohibitive interest rates that really eat into affordability, was a real stickiness going on to house prices. And we'll get into that in a minute. But overall, what we're seeing right now in the marketplace is our inventories are rising. And it's been rising year over year. And we compare the rising inventory to demand that is almost the same year over year. So if you have inventory that continues to rise year after year, and it's getting more and more, where there's more homeowners that are coming on the market, even more homeowners coming on the market, and even more coming on the market. As a result, you match that up against this demand that is the same over time, year over year. What's happening is the market is slowing. There are more homes coming on, so they're actually accumulating over time. And you can't really see it utilizing, when you look at the macro environment of all of the National Association of Realtors houses across the United States, you can't really see the big changes in the marketplace. On the right-hand side, you can see this little clip, and that is for the first couple months of 2025. But you can't really tell what the inventory looks like, especially compared to the Great Recession. And this goes all the way back to 1982. So we have a lot of data that goes backwards so that we can see things that are occurring going forward. However, when you look at it like this, you're not really seeing the big year-over-year difference. And so what I'm going to do is I'm going to show you what Southern California looks like. And this is actually as of last night. We pulled the data for all of Southern California, and you can see where the inventory levels are. It is much higher than last year. Each one of those mountains is a year, and we're beginning the 2025 mountain. You can see the 2024 mountain is next to it, and it's already exceeded where we were in 2024, and definitely in 2023. And 2022 is that other larger mountain, but once again, we've exceeded all of those, and we're getting towards where we were at prior to COVID. Because if you look at this, this is from 2012 on, and it looks like we're very, very similar to pre-pandemic numbers. And you could see it here with looking at Southern California year over year. And now this chart explains everything probably the best. And that is, you could see the blue line, that is 2023. The purple line is 2024. And the red line is 2025. That green line is the 3-year average prior to the pandemic. And for a lot of markets, not all markets are higher than they were prior to the pandemic, but Southern California as a whole is just about to eclipse that pre-pandemic level, the 3-year average prior. And so what happened was, in that blue line, that was 2023. And there were very, very few homeowners that came on the market, compared to the typical number of homes that come on the market on a monthly basis, year in, year out, prior to the pandemic. And then we got to 2023, and in 2022, we went from 3.25% to over 7%. And as a result, a lot of people said, yeah, nobody's moving. They're locked into their mortgages. It's not necessarily that they were locked into their mortgage. Instead, they were choosing to stay put. And they were waiting for rates to come down, or for whatever reason, they just didn't like the fact that rates are much higher than the rate that they had on their existing home right now. So a lot of people did not place their homes on the market in exchange for another one, because they remembered at first in 2023, back in August of 2022, there were rates that were as low as 5%, which, by the way, August of 2022 is the last time that mortgage rates were in the fives. And so that's almost 3 years ago. Just in a few short months, we will hit that 3-year mark of being stuck at 6% or higher. So if you look at 2023, very few homes came on the market, and inventory had a very hard time growing. And that's because not many homes were coming on the market. People were what I refer to as hunkering down. They were deciding not to place their home on the market. Then you got to last year. Well, there were more homes that came on the market last year than there were in 2023. So 2024, you had more homeowners participating. Still not as many as where we were prior to the pandemic. However, it is more than 2023, and still similar year over year demand. So those extra homes that were coming on the market were accumulating and built that inventory that occurred on that purple line, where you see the inventory continuing to grow all the way through the fall. This year, 2025, there are even more homes coming on the market than last year, which beats the socks off of 2023, and still very, very similar demand. So that is why that red line, you see, it is going up at a very, very fast clip, very fast rate. And the reason for that is more homes are now accumulating, so we're building even more of an inventory because interest rates really have not changed that much. And this hunkering down trend, basically 40% of all Americans own their homes free and clear. The rest have a mortgage. That means that, and this is through the fourth quarter of 2024, this is taken from the National Mortgage Database, 73% of all Americans that have a mortgage have an interest rate at 5% or lower. 55% have an interest rate at 4% or lower, and 21% have an interest rate at 3% or lower. So there are a lot of people that have these very low interest rates. And at first they're saying, I'm not going to move. But I even have asked people in the various meetings that I have conducted, if you have an interest rate at 3% or lower, raise your hand. A lot of hands go up. Then I ask them, are any of you planning on making a move within the next couple of years? Hey, about a year ago, I had no hands go up. Now I'm asking and continuing to ask that question, and more hands are starting to go up. And why? It's because they're so tired of waiting. They're tired of hunkering down. They don't believe that interest rates will ever get into the fives again. So They're no longer happy with staying put. Like this family right here, did everything right. They got married, they had babies, yet they're outgrowing their house. They're doing everything on their porch. They want to move. And it gets to a point where, gosh, how long do they have to wait before they're able to move? And many homeowners are deciding, I'm not waiting any longer, and I'm moving. And you could see this, once again, this is Altos research. This is from across the United States. It's very hard to see the data when you're looking at across the United States. The purple line is the number of homes coming on the market on a weekly basis versus the blue line. That's the purple line is this year. Blue line is last year. The lowest line that's actually in gray is actually 2023. So there are a lot more homes coming on market this year compared to 2 years ago. And there are more homes this year than last year. But I like to, again, drill it down to Southern California because really you can start to see it because now you're going from this big macro area to a micro area. And it really does illustrate what's going on. That red line is this year. The purple line is last year and the blue line is 2023. And you can see how many more homes are coming on the market on a monthly basis this year, the red line, compared to the last couple of years. Up at the top, that spaghetti is prior to the pandemic. So we are making our way to where we were prior to the pandemic with the number of homes coming on the market. So we're going to get there. We're just not quite there yet. But still, demand is not changing. So when you got demand not changing, you have more homes coming on the market. Now you understand why there's an accumulation of homes on the market. So as a result, what is the speed of the market? And it's something we call expected market time. I hate days on market. I hate absorption rates based upon closed sales data. The reason I use the word hate is because it's just really dated. And days on market is a horrible statistic. Absorption rate based upon sales is like in the past. I want more of an absorption rate based upon pending sales and looking at the current active inventory of available homes, what I refer to as supply and demand, and we come up with expected market time. Place your home on the market when you're going to become a pending sale. And you can actually see where we're at. Now, if you look at going back in the past, we're actually at a pretty high level. The only time that it really exceeded that were just a couple times. The big spike in the middle was when we hit 5% interest rates in 2018. It really slowed down in all markets across the United States. And this is where we are right now. And that's through actually as of last night. That red line is this year. The green line is the 3 years prior to the pandemic. The purple line is last year and the blue line is 2 years ago. That orange line is 2022, by the way, in case you're wondering. But you can see that the market's a lot slower than anything that anybody's been used to. It is not as slow as where we were prior to the expansion and during the Great Recession. During the Great Recession, we had expected market times that exceeded a year. And right now we're right at about 100 days. So you have to have like 3 times as slow of a market, which we're most likely not going to get to. I'll explain in a second. So a lot of people are wondering, gosh, it is a lot slower. Yes, you're right. Is it that housing crash? The answer is no. It's not a housing crash at all. There's a big reason it's not a housing crash. It is the housing cracks that we're seeing in the strong foundation of the housing market. This housing, all the housing stock across the United States is the strongest of all time. And I've gone over it in many different ways in a lot of different housing debriefs. But the best way is actually to take a look at something like this. And I know that this is a lot of words. I'm not used to putting words up there. But I want to talk to you about the difference between the Great Recession housing market and today's housing market. And that is there was low or no down payments were very common versus a lot larger down payments today. There were subprime loans, pick a payment plan, teaser rate, adjustable mortgage, fraudulent lending versus tight qualifications and strict lending standards. The average FICO score prior to the Great Recession was 681 in 2006 versus 740 today. And there was a flood of cash out refinances. Homes were used as ATMs. There was minimal number of cash out refinances. The national delinquency rate in June prior to the Great Recession from 2000 to 2005 was at 4.7%. And the current national delinquency rate is at 3.5%. So we're far lower than where we were even the 5 years way prior to any type of the Great Recession showing, which we started to see it at the very end of 2005. In the Great Housing Recession, there's $5 trillion of tappable equity. That's the amount of money that it can be refinanced and still have 20% equity. And there is now $17.2 trillion of tappable equity. 23% of all homeowners had negative equity in 2009. There's 0.6% of all homes have negative equity right now. 31% of all homeowners had no mortgage in 2006. 40% have no mortgage. There are 574,000 BKs per quarter prior to the Great Recession. There are right now 126,000 BKs. And in the third quarter, I just looked, it was actually the same for the fourth quarter of 2024. So you get it. Big difference between the Great Recession prior to where we are right now. It means that there aren't that many people out there that are going to get in a pickle. Even if we went into a recession, which I talked about last week in last week's episode, there aren't that many people that are going to be in a pickle where they have to sell. So as a result, prices are very sticky. No one's going to give away the farm. They're just going to continue to keep their home if they don't get their price. So the market is slowing. It will continue to slow. We might see, and most likely in many, many markets for the second half of 2025, we will see prices come down. So that kind of explains where we're at right now. I hope everybody understands. We're not crashing. This is not any sort of a crash that's building. But this is a crack in the foundation of the housing market where we're going to see a slowdown until we have rates that come down towards 6%. Once we get below 6.5%, which we're not far from, it'll take the slowdown of the economy to bring the interest rates down to below 6.5%, and that would improve the housing market once we were below 6.5% with duration. So if you like what you see, go to reportsonhousing.com. The most recent report is Fracture in the Market. We're developing a new report that's coming out this week. And we have reports that are throughout SoCal, Bay Area, Phoenix, and Las Vegas. And utilize the coupon code CRACKS for a free month. And I hope you enjoyed this week's housing debrief. And hope you have a fantastic weekend. Do you want to say anything, Clipper Boy? So I do have a special guest today, and this is Ezekiel. Say hi, Zeke.
Hi.
He has a basketball game in about an hour and a half, his last basketball game of the season. So hopefully he scores 1 million buckets. What do you think?
Maybe, but we're still losing. But
that's okay.
We never made even one.
They haven't. He was on a game where the team where they were winning like crazy. Now he's on the opposite kind of a team, but they are improving, right? Making lots of shots. So anyway, hope you have a fantastic finish to your week. We'll see you on the other side. Thank you so much.